I love investing. And in fact, I've been investing in the stock market for about 7 years now. And the more I go through this process and learn from my past experiences, I'm starting to realize why and how I'm leaning a lot more towards passive investing. In fact, right now, close to 90% of my investments are in passive investments options, such as index funds and ETFs. And only about 10% of my investments are in the stocks, handpicking stocks, or in the crypto business. But I wasn't always like this. In fact, when I started first investing in the stock market, I dabbled in so many different things, you name it, from stock picking in various sectors and industries to covered call ETFs, different types of exchange traded funds, crypto investing, and you name it. But overall, based on my personal experiences and learnings, as well as the research that I've done and reading around some of the best investors out there, such as Warren Buffett and their approach to investing, I've started to come to realize why investing passively in low-cost index funds is one of the greatest ways for any investors to really pursue that goal of achieving wealth creation and financial independence. In this video, I'm going to be sharing with you the top 3 reasons why I'm personally pursuing investing passively in the stock market and why you should possibly consider the same. All right, the very first reason why I like to invest passively in the stock market through index funds is the fact that index funds offer a low-cost option for investing. At the same time, it combines that with the opportunity to diversify my investments. In other words, it makes it so easy for me to invest in the stock market. I don't need to spend hours upon hours of time to do research on different stocks that are out there, listen to conference calls, read through the analyst estimates of stocks, which, let's face it, in many cases, it could go either way. And in many cases, when you are reading actually through the stock analysis by different analysts, there are few of them that are always very bullish about one stocks, and definitely there are some that are very bearish about one. You kind of are undecided in many cases. What's really happening here and why there's such polar opposite points of view regarding the shares of a company? I don't know about you, but for me, I'd rather spend my valuable time on something that I enjoyed the most. I don't want to spend hours upon hours doing research on a stock, a particular stock that at the end of the day, I'm not going to be even sure what the future direction of it is going to be. I'd rather spend that time with my family and on the things that I enjoy the most. Therefore, index funds is an amazing option for me because I'm going to get that diversification and invest in the stock market more broadly. Say if I pick a fund such as the Vanguard Total Stock Market Index Fund or a Vanguard S&P 500 Index Fund, they are giving me exposure to a much broader set of companies, high quality companies in the stock market. And I can be rest assured that I can achieve the average returns for the market. The second reason why I like investing passively in the stock market is that I can comfortably sleep at night. And it's important for me. With stocks, they are typically a lot more volatile, whereas with index funds, given that they have a lot higher diversification, their volatility for the prices of the fund is usually less compared to handpicking stocks. On top of that, given the diversification of that risk to ETFs, even though my funds may lose their value, I'm not as concerned about it. Whereas I know in the past, for instance, I've been investing in a particular stock and that stock might have lost its value. Now the stock is down by 20, 30%. I'm not gonna lie. There are times that I'm starting to panic, even though I kept telling myself the fundamentals of the company is intact. It's a business that I believe in, and I'm there for the long term. Still, psychologically, I can't just pretend that nothing has happened. It really has a negative impact on my perceptions and on my comfort level. Whereas when it comes to index funds, because here my risk is more diversified and I'm not only exposed to one single company. In many cases, I'm getting exposure to 500 companies or 3,000 companies, and sometimes a few hundred companies. As a result of that, the risk tolerance that I have is higher. Even if the value of the funds goes down, I'm a lot more confident to put more money and invest more and buy more shares of that specific index fund, knowing that I'm not, in a sense, putting all my eggs in one basket. Indirectly, I'm getting exposure to multiple hundred companies for the most part in many of these index funds that I'm exposed to. The third and final reason why I'm leaning towards investing passively in the stock market is based on my readings and kind of trying to also learn and follow the wisdom of the gurus of investing. And in this case, I'm referring to Mr. Warren Buffett. A few years ago, back in 2008, Mr. Buffett had a bet and he challenged fund managers out there to kind of go on a bet with him, put about $500,000 investing in their chosen funds. And his bet was that within a span of 10 years time frame, investing passively in the S&P 500, US S&P 500, unmanaged funds would actually beat that of the fund managers. There were not a lot of demand for his bet. In fact, over that span of time, there was only one fund manager at the time that was willing to put his money where his mouth is and kind of got into this bet with Mr. Buffett. And Warren Buffett, in his letter, shareholders letter back in 2017, he touched on that and some of the outcomes of that 10-year time frame. If you look at it, there's this article from CNBC Make It, CNBC Money, that also touches on that. This was published in 2022, talking about Mr. Buffett swearing by this inexpensive investing strategy, referring to investing passively in low-cost index funds such as the S&P 500. And they talk about how his bet was that over that 10-year time period, commencing January 1st, 2008, and ending December 31st of 2017, the S&P 500 would outperform a portfolio of 5 hedge funds of funds when performance was measured on a basis net of fees, costs, and expenses. And in fact, his funds managed to crush it based on the outstanding returns that it had. At the end of that time frame, as you notice, the funds selected by the contestant and the fund manager only returned a total of 36.3% net of fees over that 10-year, and the S&P 500 index fund had a return of 125.8%. Here's the reference in his shareholders letter that he talks about his bet. He talks about he publicly offering a wager of $500,000 that no investment professional could select a set of at least 5 hedge funds that would, over an extended period of time, match the performance of unmanaged S&P 500 index fund, charging only token fees. And in this case, he goes on to say that of all those people who claim that they are the greatest and the best in terms of managing funds, pretty much most of them feared putting a little bit of their own money on their line. And there was only one person, in this case, Ted Țe'Dis. He stepped up to that challenge, and he was at the time a co-manager of Protege Partners, an asset manager that had raised money from limited partners to form a fund of funds, in which is a fund that invests in multiple hedge funds. And then he touches on that. This letter was in 2017, so earlier in the year. At the time, this 10-year time period was not quite fully done, but he was sharing that letter. Here are the results for the first 9 years of the bet. He shares that those first 9 years figures, leaving no doubt that his approach actually managed to really perform a lot better than that of the other funds. In this case, the fund manager had 5 funds of funds A, fund B, C, D, E, and you could see their cumulative return at the end of the 9 years. The first one, 8.7% positive gain. The second one, 28.3%. Third one, 62.8%. Fourth one, 2.9%, and fifth one, 7.5%. Whereas the S&P 500 index fund, with such a low fee for Mr. Buffett, had a cumulative of 85.4% return. He's also talking about that based on his agreement, the names of those funds have never been publicly disclosed, but he could see their annual audits. Based on those first 9 years, the compounded annual increase for the index fund of S&P 500 was 7.1, which is a return that you could typically expect from a stock market over time. And on the other hand, though, for the funds of funds, when you take those all to account for their overall return, it was an average of only 2.2%. It was such a abysmal return compounded annually. And in this case, he goes on to put an example. That means that $1 million invested in those funds would have only gained $220,000. Nice, a little bit of change. But if you compare that to that of return for the S&P 500. In that case, the index fund would meanwhile have gained $854,000, close to 4 times more, just a massive return. This just goes to show you that in many cases you hear from fund managers and account managers that they are there to outperform the market. They know how to invest and they can do it, bring forward the best returns for you. The truth of the matter is they might be lucky in 1 year and accomplish that, but over long enough span of time, they won't be able to do that. And anybody who claims that they are able to do so continuously over the years, probably they're lying to you. And the truth of the matter is, we know, even having heard that from the genius of investing, somebody like Warren Buffett. And through that experience, we saw firsthand how, in many cases, fund managers and humans as a whole start to make poor decisions. We get irrational. We might sell stocks when, at the wrong time. We sell it maybe when we've had some gains, or sell it maybe when the stocks are down. Whereas being patient, sitting on the sideline, and diversifying our investments through low-cost options such as S&P 500 index fund or other index funds that are out there for total market, probably would be one of the wisest way for anybody to generate wealth. And in fact, that's the way that I'm pursuing my own finances, which is why I put almost more than 90% of our funds into passive income index funds that exist. This includes the S&P 500 index fund for the US exposure. We have some exposure to the Canadian market through index funds. In fact, there are 2 different ones that I'm very invested in. One more geared toward dividend, and the other one more for Canadian stock market as a whole. We also have exposure to international markets as well as the emerging market. Those are the 4 kind of areas that we are focused on through our index fund investing passively. And for our portfolio as a whole, between my wife and I, the fee that we are charged on these overall portfolio currently is at only about 0.17%. The reason that the fee is slightly higher is that a good chunk of our investments are actually in one of the funds called VDY, and it's more geared towards dividend, but it does have a higher fee. I think the MER for that is around 0.22%. That said, these fees are nothing, I would say, compared to that of the 2% or 3% fees that are easily being charged by many of the mutual funds or financial advisors out there for the type of funds that they invest you in. So if you're invested through a fund manager or through an organization that they pick these funds for you, I definitely encourage you to make sure you do your research. Ask them point blank and understand what is the fee that you're paying, what's the MER or management expense ratio that you're paying on those funds. Many times these funds are actually newer funds, so maybe they were incepted only in 2020, and during those years, if you know, during the pandemic, there were massive returns for the market. So they have amazing returns, and as a result of that, they are showing, wow, look at that. S&P 500 had only about, let's say, 25% return, and we had 40% return. Wow, amazing. But how's that have changed over time? How about 2021? How about 2022? If you look at it more closely, you're starting to see that they might have been able to beat the market in that 1 year, but they haven't definitely been able to do so continuously over long enough time span. Be sure to do your research and let us know if you have any question. We are not a financial advisor. The content of this video and what we are sharing here is based on our personal experience. I'm just a regular investor who is putting money aside proactively and investing them in avenues and in funds that I believe are the best suitable ones for our circumstances to help us grow our funds and build a cushion for our retirement years. We are pursuing that journey of financial independence and financial freedom, and I wish for you nothing but the same. Being able to take control of your finances and being able to see the light at the end of that tunnel, that you are getting closer and closer to your goal of hopefully reaching that financial abundance, financial freedom, and financial independence. Thank you so much for watching this video until the end. I hope you found it beneficial and hopefully it was inspiring to you. If you gained something of value from it, don't forget to give this video a thumbs up and subscribe to our channel. Here on Momentum Finance, we post every week videos about investing, including investing in stock market passively, and sometimes we talk about investing actively here and there, because I know there's always that thrill of investing, and I also do about that 10% or so of my investment actively, just a smaller portion of my portfolio. We also talk about investing in real estate as well as ways to reach financial freedom. Thank you, and I hope to see you all next time.